Hello and good morning, folks. This is Almus Market Mornings with me, Shikhar Garg. And folks, before we go ahead with the updates for the day, my heart goes out to all the folks out there in Syria and Turkey having a tough time with the massive quakes. I hope they have all the strength to move past these testing times. Coming back to the updates, folks, US plans on to have 200% of tariffs induced on the Russian aluminium, while on the other hand, down south, we see Australia recording a fifth straight consistent year of trade surpluses. Now, these are two very different events. One wherein geopolitics continues to rule the roost, and on the other hand, an undeterred economy with all the varied set of crises and things happening around in the markets. But Australia continues to be a trade surplus economy. That's quite interesting to watch out. But as we heard in the last week on the strong NFP numbers, now the markets are keen on watching what the Fed governors are looking for and what's their thought processes to finally gauge whether there are any rate cuts to be expected as they were expecting earlier, or it's going to take some time before they move ahead. So, JK, I'd like to know from you what are your thoughts on these fronts. We also have significant moves in the currencies going on. So, what would RBI would be thinking about with their actions in tomorrow's meeting?
Good morning. Yeah, I think to respond to your point on Australian jobs, Australian economy definitely done well, and with China opening up, the numbers have got even better. We have RBA policy meeting in just another 70 minutes or so, and that will be another quarter point hike from Reserve Bank of Australia. Apart from that, yes, the geopolitics is back in play. Yesterday, we updated on US shooting down balloon, presumably a surveillance equipment, obviously straining some relations between the two countries. And Europe, on the other hand, rather the G7, on the other hand, has imposed price caps on many of the petroleum products. Now, this is not just on crude, the derived products from petrol also has been capped by European countries, which effectively starts from, this week. So the geopolitics is in full play, and dollar index, meanwhile, has been roaring back to life. The blowout jobs report, which turned it on its head, is now focused on reactions of Fed members, of which we have plenty to digest this week. The most important, of course, would be what Powell says in his interview at the Economic Club of Washington today. He had spoken a few times about the disinflationary process taking over in his press conference, which the market had taken dovishly. Although he had continued his stress on the jobs market, his reaction to the stunning jobs report last Friday would have to further narrow expectations on future monetary policy moves between the market and the Fed. Yesterday, Bostic, who was earlier seen as a dovish Fed member, said high peak rate was on the table after jobs blowout. FOMC would consider moving back to even a 50 basis point hike if needed. Mary Daly already reacted on Friday, saying that it was the wow number and Fed could go beyond 5.1%. So if you sided with some minority interpretations of US jobs, saying it was mainly on the temporary worker side, one cannot ignore the services PMI, which showed activity roaring back to expansion territory after a month's hiatus. And the data on Friday have erased memories of weak numbers which we had off late in the last 1 month. Thus, what we are seeing now is a fresh repricing of bonds and the dollar. The rampage in bond markets continued from where it left on Friday, with 10-year moving another 12 BPs higher and 2-year gaining nearly 19 BPs from closing level of Friday. Adding to bearishness on the bond for statements from a few Bank of England MPC members who sounded more hawkish and seemed to hint on risks of persistent inflation. And as yields kept moving higher, Nasdaq had another 1% loss on Monday, with its close correlation on interest rates being well known. Next cues will be from Powell, obviously what I mentioned earlier, and the CPI number due next Tuesday. That's some time away. So after 5 weeks of gains for the tech-heavy index, we are in for a couple of weeks of correction consolidation. In the global markets, investors sold both currencies and the stocks, particularly in Asia, correcting the strong rally of the last 11 months. The fresh geopolitical tension between US and China after a farmer shot down the balloon, and also the earthquake of 100-year, strongest earthquake in the last 100 years, in which struck Turkey, killing more than 3,000 people, led to more unwinding of risk assets. Even the Turkey lira hit a new all-time low. Gold has had a much steeper fall from the highs out of the jobs report, losing as much as 5% in just 2 trading sessions. It has quickly reached 1860 from 1959. And now that is possibly nearing a zone where renewed central bank interest may be seen. So a move back above 1880 will bring back some confidence to the bulls. Eurozone saw a mixed bag of data. Factory orders came in very strong at 3.2% versus 2% expected. Global construction PMI for Eurozone jumped to 46.1 from 42.6. And of course, Eurozone retail sales came at minus 2.7, but it was still close to what was expected. While the US Euro sentiment, which improved by more to -8 from -17.5. However, since it pertains to December, it may be seen as a backward-looking data. Overall, Eurozone economy has been much better, and currently Euro fall should be seen as a healthy correction. On the other hand, Yellen's statement that US economy could avoid a recession lent support to the dollar. Overall, Yen continues to be depressed on the prospects of another Dow taking rates from crude in April, despite official denials. On the rupee front, we had the fresh dollar index rally that has not spared it, which continues to play out the bias of the players, that is participate in dollar strength but underperform when the greenback is falling. Adding to it, the ongoing corporate issues, the domestic stock valuations, the sentiment did not take much time to shift to the weaker side after promising a rally on Friday. The global dollar strength, geopolitics, and weakness and put strong brakes on any rally in the rupee. A statement by one of the government officials that India would go for inclusion of Indian bonds in the global index on its own terms and will not bend backwards dampened any expectation of early decision in this regard. We did see some intervention from state-run banks ahead of 80 to 50 levels yesterday, but the impact did not last. One can, however, say that the rupee has not fallen as much as other currencies in Asia, but that is also due to the fact that when dollar was falling, we did not see a rise in the rupee as well. That said, DXY expected to correct deeper towards 105, 104. We cannot rule out rupee falling to its all-time lows. Once again, just watch out the trend in the dollar index. I'll just end this update with a simple explanation by someone as to why inflation fears are not going away. Without people fearing that they're going to lose their jobs, they don't really spend less and they don't change their behaviors enough to start bringing down the inflation. That's one of the analysis on inflation. Thank you.
Okay, JK, and that's really quite interesting. I mean, folks, there it couldn't be anymore, right? I mean, the way our behavioral biases and our actions are seen, it makes more sense. What JK mentioned, that as long as there's no fear about losing the jobs, the spending would continue to most of its extent, and that's why inflation, although was some bit of it from the supply side. A good supply of money also ensured there should be inflation, and that's what we are observing right now. On the other hand, folks, we still await clues from Powell on what the Fed governor is looking for in the coming days. But all said and done, we are in for some good corrections and consolidations over the period after a good move on the DXY on downside. There was a mixed bag of data, as JK mentioned, on the Eurozone, but for the Indian markets, it was observed that the central bank was not having a strong intervention, or rather, we should say we had a very mild intervention, because there's not much of weakness that we have observed in the Indian rupee when we compare it with the rest of the EMs. So it's quite interesting to watch out how things go about. folks, we are having the Australian Central Bank meeting today and the Indian Central Bank meeting tomorrow. There's a lot of updates going on, and we shall come back with all such updates with only for you. Thank you so much for joining and listening. We shall come back again tomorrow.